You are being played by retail headlines while the smart money frontruns a kinetic regional war. Preemptive, joint U.S.-Israel airstrikes hit Tehran, targeting the presidential palace. Plumes of smoke are billowing over central Tehran, sparking fears of an all-out regional conflict in the oil-rich heart of the Middle East. Iran completely closed its airspace and suspended trading on the Tehran Stock Exchange amid internet blackouts. The mainstream media will tell you this is standard geopolitical theater. It is not. The strikes on Tehran were coordinated, and Wall Street already bought the physical exit. Look at the tape. Simultaneously, JPMorgan updated its late 2026 gold target to $6,300 per ounce. The bank is projecting spot gold to surge another 22% from current levels by year-end 2026. That $6,300 target is a massive, mathematically significant upgrade from their late December outlook, which predicted gold would break $5,055 based on strong fundamentals. The investment giant also hiked its long-term baseline price target to $4,500, but the 2026 trajectory is locked onto a violent repricing. I sell nothing. I don't want your trust. Pull the primary reports and verify the math yourself. This is financial warfare. If you are actually paying attention, drop 3 words in the comments, verify the math. Let us deconstruct the mechanics of what just happened. The military operation was coordinated closely with the United States and was reportedly months in the making. Israeli security sources claimed the final trigger was pulled after an assessment concluded that negotiations with Iran were a dead end. This escalation follows a collapse of third-round talks in Switzerland. Secretary of State Marco Rubio had previously called Iran's refusal to discuss its ballistic missile program a massive deal-breaker. President Trump stated that the U.S. has officially launched large-scale combat operations to neutralize the threat. He warned that Iran's naval assets are on the brink of total annihilation. The U.S. military presence in the region is now at its highest level since the 2003 invasion of Iraq. This is not abstract foreign policy. This is the catalyst global capital required. When a sovereign nation shuts down its airspace, freezes its stock exchange, and goes dark, paper markets in the West are the last to reflect the true cost. The institutions are not waiting for the mainstream media to explain the fallout. They are moving capital aggressively. JPMorgan stated that robust, sustained demand from both central banks and investors throughout 2026 will eventually catapult the precious metal to $6,300 per ounce. Natasha Keneva, head of Global Commodities Strategy, made the institutional perspective clear. The trend toward higher repricing is far from exhausted, and the long-term shift toward official reserves and investor diversification still has legs. The smart money knows exactly what is happening. You are watching the violent divergence between the retail narrative and the tape. The media peddles a soft landing illusion to keep retail trapped in fiat and equities. The tape shows JPMorgan analysts effectively front-running a regional war by calling for $6,300 gold while bombs decimate government hubs in Tehran. The missiles are flying. The institutions are out of paper and into physical. Verify the JPMorgan report yourself. Verify the airspace closures. Do the math. Turn on any mainstream financial network today. You will hear the exact same rehearsed chorus. The structural cover story being fed to retail is a cocktail of falling U.S. interest rates, a softening dollar, and standard geopolitical jitters. They tell you the system is simply recalibrating. They peddle a soft landing illusion to keep you trapped in fiat and paper equities while the exit doors quietly lock. That is the surface level noise. Now look at the tape. The tape does not lie, and the tape does not care about your feelings. What the data actually shows is an aggressive, calculated rotation into physical metals by the largest players on Earth. This is not a temporary flight to safety. This is a permanent baseline shift. While the media talks about temporary jitters, the smartest money in the room is executing a mathematical exit. JPMorgan is not guessing. Their commodity analysts are openly projecting spot gold will surge another 22% from current levels by the end of 2026. Think about the underlying mechanics. A 22% surge on an asset this heavy requires hundreds of billions in sustained, relentless institutional capital flow. Bank of America is moving even faster. They are officially calling for $6,000 gold within the next 12 months. Not 5 years. 12 months. And they are not stopping at gold. Bank of America projects that silver will reclaim the $100 level later this year, acknowledging that while there may be a short-term pullback, the upward trajectory is inevitable. When two of the largest banking institutions on the planet publicly broadcast targets of $6,000 and $6,300 for a physical asset, they are not predicting a standard bull market. They are confirming a systemic fracture. The soft landing narrative relies entirely on the assumption that U.S. Treasuries remain the undisputed risk-free asset. The tape tells a completely different story. JPMorgan itself admits that gold is now pulling double duty. It is acting simultaneously as a currency debasement hedge and a direct, non-yielding rival to U.S. Treasuries and money market funds. When the risk-free asset of the world is being challenged by a physical metal, you are not looking at standard market dynamics. You are witnessing the unwinding of the dollar-centric reserve system. Retail traders are being conditioned to sell the rips. They are being trained to trade the volatility and play with paper derivatives while the physical foundation is systematically drained. The institutions are doing the exact opposite. They are using the cover of a softening dollar and rate cut noise to quietly accumulate the physical baseline. They are hedging against a sovereign debt spiral and a kinetic war that has already begun. The $6,000 target from Bank of America within 12 months is an alarm bell ringing in plain sight. Silver reclaiming $100 exposes the reality of the physical deficit. Paper markets can suppress the price temporarily, but they cannot print physical metal. The mainstream calls it a rally. The institutions know it is a rescue operation. The numbers expose the paper trap. Institutions and central banks are not trading the chart. They are actively draining the physical system. This is a mathematical baseline shift. Look at the primary data. In Q3 2025 alone, central bank and investor demand hit roughly 980 tons. That is over 50% above the previous four-quarter average. At an average price of $3,458, that is a verifiable $109 billion quarterly inflow. One quarter. $109 billion. Think of this like a global bank run. But instead of retail depositors standing in line for fiat cash, sovereign nations are draining the vault for physical bullion. Central banks have already executed 3 years of record buying, hoarding over 1,000 tons annually. Now, watch how the mainstream misreads the next data point. JPMorgan expects 2026 central bank purchases to drop slightly to 755 tons. The financial anchors will call this a slowdown. They will call it a top. They are entirely wrong. This is not a strategy pivot. It is pure arithmetic. Analysts confirm that at prices over $4,000, central banks simply need fewer ounces to hit their desired reserve percentages. If a sovereign target is a 15% gold allocation against its fiat reserves, and the nominal price of gold surges, the required tonnage drops. They are not buying less because they lost conviction. They are buying less tonnage because they recognize the asset has fundamentally re-rated. At higher nominal prices, they require less physical weight to secure their reserves. The paper illusion relies on the assumption of infinite supply. The numbers prove the physical supply is leaving the building. The micro-anomaly of physical metals leaving the vaults does not exist in a vacuum. It is currently colliding with a state-level explosion. The kinetic war in the Middle East is not just another geopolitical flare-up for retail to trade on the margins. It is the specific catalyst for the final structural break in U.S. dollar hegemony. Look at the tape. The President of the United States just struck a defiant tone following the strikes. The U.S. officially launched large-scale combat operations. The U.S. military presence in the region is now at its highest level since the 2003 invasion of Iraq. The administration has shifted from failed diplomacy to hard military force, explicitly threatening the total annihilation of Iran's naval assets. Do not read this as political news. Read this as a massive, capital-intensive military footprint expanding rapidly in the oil-rich heart of the globe. Kinetic wars require infinite fiat printing. They shatter supply chains. They isolate hostile nations from the Western financial system, which inherently forces a recalculation of risk by every sovereign entity currently holding U.S. paper. Watch what global capital is doing in response to the bombs. It is treating gold as the primary non-yielding rival to U.S. debt as the military footprint expands. JPMorgan admits this in plain ink. They highlight that gold is pulling double duty. It is acting as a currency debasement hedge, that is the standard inflation playbook. But it is also serving as a direct, non-yielding rival to U.S. treasuries and money market funds. Understand the absolute magnitude of that admission. The U.S. Treasury market is the collateral foundation of the entire global financial system. When a Tier 1 bank openly declares that a physical metal is now a direct rival to U.S. sovereign debt, the monetary regime shift is no longer theoretical. It is fully operational. Sovereign nations look at the large-scale combat operations. They look at the deficit spending required to fund those operations. They realize the paper promises backing their reserves are mathematically depreciating in real time. So they move down the risk curve. Not into other fiat currencies, not into corporate bonds, but into base layer, non-counterparty money. Now, look at the mathematical killshot. The fiat exit doors are dangerously narrow. JPMorgan's head of base and precious metals strategy laid out the exact math. He noted that their price assumptions might actually be highly conservative. Here is the quote that should terrify anyone holding unhedged paper assets. If just 0.5% of foreign-held U.S. assets diversified into gold, that alone would provide the firepower needed to clear $6,000. Let that specific metric sink in. 0.5%. That is not a total divestment. That is not a global dump of the U.S. dollar. That is a rounding error. It is a minor portfolio rebalancing by foreign asset managers and central banks attempting to hedge their exposure to an escalating Middle Eastern war. If a mere 0.5% of the capital parked in foreign-held U.S. assets decides the geopolitical risk is too high and moves to diversify into gold, that singular inflow provides the explicit firepower needed to clear $6,000. This is a dimension-reducing analogy for you. Imagine a massive sports stadium holding 100,000 people. That stadium represents the US dollar asset market. The physical gold market is a single exit door that only fits 500 people. If even a fraction of the stadium smells smoke and moves for the exit, the premium paid to get through that single door goes parabolic. The structure simply cannot handle the volume. The smoke is already billowing over central Tehran right now. The global capital rotation is not waiting for a diplomatic resolution that is never coming. The military escalation is the trigger. The physical drain is the mechanic. The repricing is the inevitable mathematical result. Here is the honest case for caution. Because intellectual honesty is what separates signal from noise. The structural setup is locked. The physical deficit is absolute. But if you think this means a smooth, uninterrupted ride to $6,300, you are preparing to lose your capital. Short-term liquidity vacuums will slaughter the over-leveraged. JPMorgan explicitly stated this rally hasn't been, and won't be, a straight line. Bank of America openly warns that silver could see a short-term pullback before any breakout materializes. Listen to what the institutions are actually communicating. They are telling you the paper price will swing violently. They are telling you they are going to hunt liquidity. Retail traders playing paper derivatives will get wiped out in the volatility. Nothing goes up in a straight line. Look at the geopolitical tape. The sirens are already blaring across Israel as the IDF braces for a retaliatory barrage. The region is a powder keg. Tehran has explicitly vowed a devastating and decisive retaliation. Do not trade the fear, trade the market mechanics. Think through the stacked logic of a kinetic shock. When a retaliatory missile strike hits, equity markets gap down instantly. When equities collapse, highly levered funds face immediate margin calls. When a massive fund faces a margin call, it does not sell what it wants to sell. It sells what it has to sell. It sells its highly liquid paper gold and silver contracts to plug the fiat holes in its bleeding balance sheet. That mechanic triggers a temporary, violent paper liquidation in the metals market. The price of paper gold will drop, even as the physical shortage accelerates. That is not a failure of the macroeconomic thesis. That is a mechanical flush. Think of leverage in this market like standing on the edge of a cliff in a hurricane while chained to an anvil. The wind wants to push you up, but the weight will drag you into the abyss the moment the ground gives way. Leverage is a death sentence here. If you are holding leveraged paper contracts, a $200 overnight drop driven by a broader equity margin cascade will liquidate your account. The algorithms will force you out at the exact bottom, handing your position directly to the institutional buyers stepping in to absorb the cheap paper. They want you levered. They want you emotional. A multi-year repricing in a structurally broken system is mathematically designed to shake you off the asset before the terminal shift occurs. You must survive the short-term volatility to capture the long-term baseline shift. Expect the paper price to crack temporarily as the geopolitical floor gives way. The $6,300 target is not a guess. It is not a speculative projection built on hope. It is the mathematical necessity of the current geopolitical breakdown. Diplomacy is dead. The third round of talks collapsed in Switzerland. The U.S. explicitly cited Iran's ballistic missile program as a massive deal-breaker. There is no diplomatic off-ramp left. Tehran warned that if pushed, every U.S. base and service member in the region is on the menu. That is not political rhetoric. That is a stated targeting parameter for a kinetic regional war. The institutions see this. They are not waiting for the dust to settle. They are front-running the fallout right now. They are out of paper and into physical. To front-run this exact event, ETF inflows are officially projected at 250 tons for 2026. Bar and coin demand is expected to top 1,200 tons annually. Understand what those numbers mean. That is not retail traders clicking buttons on a screen. That is 1,450 tons of physical metal leaving the system, locked away in vaults, permanently removed from the deliverable float. JPMorgan is telling you exactly how this ends. The long-term shift toward official reserves is far from exhausted. The structural trend remains entirely intact. The mainstream media will keep feeding you the soft landing narrative while the Middle East burns. They want you trapped in fiat. They want you holding the bag when the dollar-centric system fractures under the weight of large-scale combat operations. They want you levered. They want you emotional. A multi-year repricing in a structurally broken system is mathematically designed to shake you off the asset before the terminal shift occurs. You must survive the short-term volatility to capture the long-term baseline shift. Expect the paper price to crack temporarily as the geopolitical floor gives way. The $6,300 target is not a guess. It is not a speculative projection built on hope. It is the mathematical necessity of the current geopolitical breakdown. Diplomacy is dead. The third round of talks collapsed in Switzerland. The U.S. explicitly cited Iran's ballistic missile program as a massive deal-breaker. There is no diplomatic off-ramp left. Tehran warned that if pushed, every U.S. base and service member in the region is on the menu. That is not political rhetoric. That is a stated targeting parameter for a kinetic regional war. The institutions see this. They are not waiting for the dust to settle. They are front-running the fallout right now. They are out of paper and into physical. To front-run this exact event, ETF inflows are officially projected at 250 tons for 2026. Bar and coin demand is expected to top 1,200 tons annually. Understand what those numbers mean. That is not retail traders clicking buttons on a screen. That is 1,450 tons of physical metal leaving the system, locked away in vaults, permanently removed from the deliverable float. JPMorgan is telling you exactly how this ends. The long-term shift toward official reserves is far from exhausted. The structural trend remains entirely intact. The mainstream media will keep feeding you the soft landing narrative while the Middle East burns. They want you trapped in fiat. They want you holding the bag when the dollar-centric system fractures under the weight of large-scale combat operations. Do not be the exit liquidity for institutional paper. This is not a market you can outsmart with leverage. This is a market you survive by understanding the underlying mechanics. When central banks and institutional investors demand thousands of tons of physical metal during a regional war, the paper price has no choice but to break higher. The short-term leverage will get cleared out violently, but the physical baseline is permanently resetting. This is the final synthesis. The $6,300 price target is the mathematical reality of a fractured world. The missiles are flying. The institutions are aggressively moving into physical. The system is mathematically starved for non-yielding safe havens. Look at the tape. Look at the strikes. Do the math. Invest with logic, not hype. OG out.